Hello and welcome to another short educational video from New Century Planning. My name is Bob Ryerson and I'm the founder of New Century Planning, and I'm very pleased and honored to have tonight with us Dave McKnight, who is a best-selling author of several compelling financial planning books. And David is going to talk to us tonight about how to build and create tax-free income for life. Dave, thank you for being here and looking forward to it.
Thanks, Bob. I appreciate you having me.
Great. You know, Dave, we talk all the time that today's retirees are really facing three large risks right now. There's the big one, longevity risk, that's the main one. But there's also inflation risk and tax rate risk, which is your specialty. And if we look at the history of tax rates just in this country, going back to 1913, we see that, relatively speaking, today's tax rates are pretty attractive from a bracket standpoint and from an actual numeric standpoint. Do you want to speak to that? I know that we also look around the world at the developed nations and we see that they're a lot higher as well. So everything else being considered, I know you're pretty much in favor of people trying to take advantage of these rates and shift money as much as possible while we still have them, right?
Yeah, I think a lot of people think that they don't have any real sense for whether tax rates today are high or whether they're low, because they don't necessarily understand the history of tax rates in our country. But if you go back in time, say to the last 2 years of World War II, we had highest marginal tax rates that were 94% on any dollar you made above and beyond $200,000. As recently as 1960, the highest marginal tax rate was 89%. And then throughout the entire decade of the 70s, the highest marginal tax rate was 70%. And people say, well, why do I care about the highest marginal tax rate? Well, as that highest marginal tax rate goes up, all of the other tax rates that affect, everyday Americans, those go up as well, and they sort of ratchet up commensurately. And so what we know is that tax rates today are as low as we've seen them in our lifetime. And given unfunded obligations for Social Security, Medicare, Medicaid, interest on the national debt, every expert that I've talked to is predicting that within the next 10 years, tax rates will have to rise dramatically. We're going to start seeing tax rates, the likes of which we haven't seen since the 1970s or 1960s. And the problem is everybody just assumes that since tax rates today are low, we sort of suffer from this, what I call the illusion of linearity. If tax rates are low today, they're always going to be low. That's just not the case. We're going to soon be forced into a position where tax rates will have to rise dramatically, or we go broke as a nation. And so this is instructive for people who are trying to wring as much efficiency as possible out of their retirement savings, like 401ks and IRAs, simply because they haven't paid the taxes on those dollars yet. And when if they're planning on taking those dollars out somewhere down the road at a period in time when tax rates are likely to be dramatically higher than they are today, then they're not going to have nearly as much after-tax spendable income as they thought.
Right, and I think people tend to underestimate the impact of taxes in retirement in general. The Americans have all been trained to save in the tax-deferred world. They're given an incentive to do so. They're trained to think they're going to be in a lower bracket when they retire. We know that may not be the case. And I think just from a common sense standpoint, we have a rapidly aging population. We have 31 trillion in debt and rising rapidly. So I think a lot of people are concerned about future tax rates, but they may not be aware of the history and how rough it can get. And the other thing I wanted you to speak about is a lot of people underestimate or are unaware of the impact of taxes on their Social Security.
That's exactly right. So I like to ask this in groups that I speak to all across the country. How many of you guys have ever heard of something called provisional income? And only about 2% of the people in the audience raise their hand and say, yes, that's a phrase that's familiar to me, which is scary, because provisional income is the income that the IRS tracks to determine if they are going to tax your Social Security. So the question becomes, what counts as provisional income? Well, if you have a lot of money in your taxable investments and those are cranking out a lot of 1099s year over year, that counts as provisional income. Any distributions from your 401k or IRA or 403b, 457, any of those tax deferred investments, those count as provisional income. And 1/2 of your Social Security also counts as provisional income. And the IRS adds all that up. And if it's a single person, it adds up to more than 34,000, or if it's a married couple, it adds up to more than 44,000. Then up to 85% of your Social Security can become taxable to you at your highest marginal tax rate. That may not seem like a big deal, but I've done the math on this 100 times in 100 different ways on 100 different clients, and this is what I've concluded. When your Social Security gets taxed, you run out of money 5 to 7 years faster than people who don't have their Social Security tax. Why? Because the act of compensating for Social Security taxation forces you to spend down all your other assets that much faster.
Right. And the other thing to keep in mind is those thresholds that you mentioned, the provisional income numbers, have not been raised since 1993. The government tends to index everything for inflation, but they kept those the same, and they're terribly low. And of course, more and more people over time get caught in this threshold of their taxes, their Social Security being taxable. And again, I think including 85% of your Social Security in your tax calculation is something that a lot of people are unaware of. And frankly, you and I know a lot of CPAs and tax preparers are unaware of provisional income. So that's a big problem. All right, we want to move on to this idea of creating tax-free income. So what is, in a nutshell, and I realize it's a lot more complicated than we can cover tonight, but generally speaking, what are the top 2 or 3 ways that people can create tax-free income? And before you answer, let's be aware or remind everybody that most people have most of their money in the tax-deferred world or in single or joint name in the taxable every year world. So having said that, maybe you want to describe the sense of the 3 buckets that we talk about all the time.
Sure. Yeah. There's lots of different ways to save for retirement. Basically, all those different types of investments fit into only 3 types of accounts, which makes it easy to conceptualize. You've got, and I like to think of them in terms of buckets of money. The first bucket we talk about is your taxable bucket. Every year, as your money grows, you get to pay a tax. These are commonly where we keep our emergency funds. You should really only have about 6 months worth of basic living expenses there because it's your least tax efficient bucket. We love that bucket because it's extremely liquid. We can get at it when we have an emergency, but from a tax efficiency perspective, it's the least efficient of all of the 3 buckets that we talked about. The second bucket, we talked about it already. You get a deduction on the front end, but when you take the money out, you have to pay taxes at whatever the rate happens to be in the year you take that money out. These are our 401ks and IRAs. And then the last bucket we talk about is tax-free, and tax-free has a cost of admission. You got to be willing to pay a tax, put money into the tax-free bucket. So these are things like Roth IRAs, Roth 401ks, conversions. We talk a lot about the LIRP, or life insurance retirement plans. Chapter 5 of my book, The Power of Zero. It's basically a maximum funded permanent life insurance policy. So you have to therefore perform this calculus that says, do I believe that paying a tax today at historically low tax rates makes more sense than postponing the payment of that tax till some point much further down the road? So that's why this question becomes so critical. Are tax rates in the future, in fact, going to be higher than they are today? Because if they are, and the experts tend to be unanimous in that regard, then we really should be thinking really, really hard about preemptively paying tax on our tax deferred assets so that we can get them into the tax-free bucket, so that regardless of what happens to tax rates over time, we've done all the heavy lifting. We can then take that money out tax-free.
Right, great point. So the money that we get over to bucket 3, the tax-free world, it's insulated, I think is a good word to use. It's insulated from whatever the heck is coming down the road. So that's pretty powerful, and it's powerful not just for the retirees, but for their loved ones. It goes on, a Roth conversion or Roth money or life insurance is tax-free all the way down. So it's very, very powerful. You mentioned a book, The Power of Zero, you wrote 10 years ago. I have to be honest with you. When Lou and I first read that book, it just blew us out because we didn't, even as professionals, we didn't think that was even possible, that you could retire at a zero bracket. And yet here we are helping people do it. Besides that book, you explained that book set the stage for how to do it. And there's a number of steps. And then you mentioned something that I should show. You wrote a book called LIRP, Look Before You LIRP. And LIRP stands for Life Insurance Retirement Plan. And that is really, a lot of people are anti-insurance, but we know that if it's used properly, and the LIRP, we're really concentrating on the RP more than the LI, right? We don't need life insurance as much in retirement. It can be used as a tool to create tax-free income, to address long-term care. I mean, you go through that in the book, but this concept that you teach all the time in your books is creating multiple streams of tax-free income. So if we convert money in an IRA or a 401k to Roth status, and there's a price of admission, it can be painful, right? We got to pay some taxes. Once we're there, we're done forever. Then you may want to explain the other book, Tax Tax-Free Income for Life, your most recent, also a bestseller. Explain how we can create lifelong income streams for people out of that bucket three, if you will, out of the tax-free world.
Yeah, so that's a great question. Is as much as I hate to admit it, the number one fear that retirees across the board have in retirement is not tax rate risk, not the fear that tax rates in the future are likely to be dramatically higher than they are today. It's right at the top of their list. It's near the top, but it's not the very top. The number one fear that people have is that they're going to run out of money before they run out of life. They're going to
Even people, we run into that fear even with people who have some serious money. They have that concern, and you know what? Maybe they should with the inflation and taxes and all the other issues. Yeah.
Harvard did a study. I talk about it in my book. That fear doesn't really go away until you have $15 million, because people just they never feel like they have enough. Once you get to 15 million, then you feel like you're sort of insulated from this longevity risk, or this risk that you'll outlive your money. But that doesn't necessarily have to be the case. There's really two ways to approach mitigating longevity risk. The first is what I call the stock market approach, which basically says build up a massive pile of money by day one of retirement, and then constrain yourself to withdrawing a little teeny tiny percentage of that money. Most experts agree that that percentage is 3%. In other words, say you got $1 million day one of retirement, you should never withdraw more than $30,000 per year adjusted for inflation if you want to have a realistic expectation that you won't run out of money before you die. This can be very, very expensive, because if you want to live on $100,000 per year, that's going to cost you $3.3 million. In other words, you have to have accumulated $3.3 million by the time you hit day one of retirement. But there's a much more cost-effective way, and that's to utilize what we call a guaranteed lifetime income annuity. Guaranteed lifetime income annuities allow you to mitigate longevity risk in a much more cost-effective way than the stock market approach. And what it allows you to do is basically you hand a chunk of your retirement savings over to an insurance company, and they guarantee you a stream of income until death. And so, for example, if somebody at age 65 wanted to get a guarantee that they would get $30,000 per year adjusted for inflation every year until they die, they would only have to hand over about $500,000. And of course, these numbers ebb and flow with interest rates, but you'd only have to hand about $500,000 over to the insurance company to get that guarantee of that same $30,000 of income. And so it becomes just a much more cost-effective way. And then all of a sudden, you can take that extra $500,000 that you didn't have to dedicate towards the stock market way of mitigating risk, and you can grow that and compound that in your stock market portfolio. And studies show that there's a lot of salutary benefits that spring from this. You live longer, you're happier, you have less stress, and you, because of those guarantees with the insurance company, you never run out of money. And that is really the most cost-effective way to mitigate what is broadly seen as the number one risk facing retirees.
The other thing is, and we are certainly pro stocks and pro bonds and pro rental real estate, all those things are great, but we try to build on top of Social Security, maybe a pension. If you don't have a pension, then the annuity serves as the private pension. Got to build some guaranteed income streams to address the basic costs. And then if we have another chunk of money coming in from these other sources that are non-guaranteed, that's icing on the cake, that's inflation, et cetera. So I agree with you. So what you're saying is using these tools, at least maybe one future income annuity or something guaranteed, the LERP. This is a way to create income for life that is not taxed. And so you need less of it. If we're not paying any taxes, then you need less, right? If we have 30,000 net tax-free, that's the same as 45 taxable maybe. So it's the whole equation gets easier.
Yeah, and one thing I really neglected to say is to be able to pull off tax-free income for life, guaranteed tax-free income for life, you have to have a certain type of annuity. It's an annuity that has what's called a piecemeal internal Roth conversion, PIRC. Every annuity company out there allows you, and by the way, when you retire and you have a 401k or an IRA, you can roll that into an annuity. So it always sort of starts off in the tax-deferred bucket, but you have to get it to the tax-free bucket. And most insurance companies these days say, yeah, we're happy to let you execute a Roth conversion on this annuity, but we're going to require you to do it all in 1 year. So let's say you got $500,000 in that annuity and you convert it all in 1 year. Well, that's going to shoot you up in your tax bracket. You're going to pay tax on most of that money at your highest marginal tax bracket. So the whole point was to avoid a doubling of tax rates over time, but you doubled your tax bracket in the short term to
No
pull it
good.
off. That doesn't do you any good. So what we're looking for are companies that offer what we call piecemeal internal Roth conversions that allow you to shift that money to tax-free over a time period of your choosing in an amount of your choosing, an amount that your financial plan calls for. So you can step that money over by way of an internal Roth conversion. And then once you've completed that Roth conversion, you can begin taking that guaranteed lifetime income out of your tax-free bucket. It doesn't count as provisional income. It's not exposed to tax rate risk over time. So it really is the best way if you're looking to shield yourself from tax rate risk, Social Security taxation, longevity risk, all at the same time within the same financial plan can be very, very powerful.
Great, great. And the partial or piecemeal approach, if it's a lot of money, it's 400,000, $500,000, $1 million, you're going to want to do that over a period of years. The other thing I think we want to return to real quick is today's brackets. If you're converting money either before retirement or shortly thereafter in retirement, a 24% marginal bracket, that's not your effective rate. Your effective rate may be 18 or 19. I think people, don't realize that. We don't want to go to the 32% bracket. That's fine, but there's something that's an effective bracket versus marginal. And again, looking historically, if we can move large chunks of money to the forever tax-free bucket and pay an effective 18, 19, 20, that's not too bad. That's pretty smart, actually, longer term. And I think the problem is, and your books help us, a lot of people are trained to defer as long as possible. In fact, their accountants tell them, if we mention Roth conversions, you're crazy. Why do you want to, And obviously, they have to be somewhat convinced about the intelligence of moving the money at today's brackets versus taking a shot on where the country's at in 5 or 10 years or 15 years.
Right. And frankly, Bob, the more you dig into the fiscal trajectory of our nation, the more you should be convinced that I think the real date is 2030. That's when most of the experts agree. That's sort of the perfect storm breaking point for the country. Some people are predicting a Great Depression, but former Comptroller General of the federal government, David Walker, is predicting that by 2030, tax rates will have to double to be able to pay for Social Security, Medicare, Medicaid, and interest on the national debt. So we can't default on the debt. So they're going to have to find new sources of revenue to pay for all of their obligations. And so really the next 7 to 8 years is going to be pretty critical for people who are contemplating moving large amounts of money from the tax deferred bucket to the tax free bucket, because once historically low tax rates disappear, they're gone forever. David Walker said this in an interview that I did with him about a year ago. He says, this you can take to the bank. Tax rates in the future will never, ever be as low as they are today.
Right. And we've got, on paper, we've got 3 years. We've got till 1/1/26 to enjoy these. So we should really look to try to move. Not that we can't move money after that, but certainly in the next 36 months. And the other thing I'll mention, and we'll close up with this idea of creating multiple streams, somebody who starts to move money from bucket one, their earnings, it's a little tough, but instead of getting that nice deduction every year in your 401k, put it into the Roth, right? You'll get a matching regardless of what you do. But building a big pile of money in bucket two is not the same as building a big pile of money in bucket three. So if you have the foresight and you swallow hard and you pay the taxes now, if somebody, in their 50s or early 60s that's going to work a few more years can make their contributions to Roths, and we just got good news on the Secure Act 2 about Roth SEPs and all these other things, there really are some things for people who have some foresight and who understand what can happen here to tax rates. They can build multiple streams of income, in a 5 or 10 year period with some discipline.
Yeah, no doubt. And people have to remember that the true purpose of a retirement savings account is not to give you a tax deduction. That's not its purpose. It's to maximize cash flow at a period in your life when you can least afford to pay the tax. And so Americans have become addicted to the tax deduction. They love saving money at historically low tax rates. But if you see that tax freight train off in the distance, and you know that it's bearing down on you, and you know that it's bearing down on you at speed, then you've got a finite number of years in which to do something about it, then I think when more and more Americans recognize this, they're going to start preemptively taking action to get those highly taxable dollars off the train tracks and into safe accounts that are shielded or insulated, like you said, from the impact of higher taxes.
Right, and I think it goes without saying, and we'll finish with this, and I thank you for your time. This is usually not a do-it-yourself situation to coordinate all these tax-free streams of income and these strategies. A Roth, a multi-year Roth conversion study that includes maybe state taxes and Social Security taxes and Medicare premium. We run comprehensive Roth conversion studies for people and show them exactly what the math is, and then it's a little easier. But I would say to you, and you're the book writer, we're the implementers here. For most people, this is something where they really need to consult advisors who are familiar with and adept at this planning, because it's very different than what most of the world does and what most of the advisors do. Everything's deferred, and these people are going to get whacked in the future if tax rates do half of what we think they're going to do. It's going to be a rude surprise, I think. And I'll finish one other thought to you. We know that 85% is the max on the Social Security. How easy would it be in a bad economic environment for the government to say, you know what, anybody north of whatever, 50 grand, 60 grand, it's 100% includable instead of 85. So there's a lot of little things they can do. And I think, having some foresight and working with professionals to coordinate this is something that everybody should look at. It's coming. Yeah. It's coming.
And I will close with this, Bob, that the path to the 0% tax bracket, and why would somebody want to be in the 0% tax bracket? Because if tax rates double, like a lot of experts are predicting, 2 times 0 is still 0. I mean, but the path to the 0% tax bracket is fraught with pitfalls. I've been doing this for over 25 years. I've helped put thousands of Americans on the road to the 0% tax bracket. I can tell you right now that unless you have a seasoned veteran like you and Lou, who have been down this road before and know what the pitfalls are. I mean, it's complicated stuff. You violate a threshold on this hand and you flip a switch on the other hand. It causes your tax rates to go up over here. There's all sorts. The next book I'm going to write is the top 10 pitfalls that people fall into when they try to navigate this on their own. And so I would encourage people watching this video to work with a seasoned expert like you and Lou that can shepherd you through this process and help you circumnavigate all of those pitfalls so that you arrive safely at the 0% tax bracket before tax rates go up for good.
And I will say, thank you. And I will say to you, Dave, that if we can't get somebody to 0, but we can get them to 4% or 7 or 8 and taxes double, it's still, any steps you take that can shelter you or insulate you from what's coming in the future makes some sense. So listen, I appreciate your time tonight. Thank you so much. And we'll talk to you again soon. Thank you.
Thanks, Bob. My pleasure.
All right. Take care.